Your credit score is probably the most expensive thing in your life that you didn't actually buy. You check it with the same energy you use when Googling symptoms, hoping it's fine while already expecting disappointment. But the idea that it measures responsibility is one of those comforting lies we've all agreed to because the truth is inconvenient. It's actually part of a larger system that rewards you for owing money and punishes you for being too competent. And the slow financial damage it does is the kind you only notice decades later, usually while wondering why your neighbor somehow retired early. If you want to keep being aware of these cheerful little traps, feel free to like and subscribe so we can suffer through them together. Right now, let's break down what this score really represents and why it quietly controls more of your life than it should. Chapter 1. The hidden cost of a low credit score. Have you ever noticed that your credit score has the unique ability to make you feel financially incompetent without actually explaining what you did wrong? You just stare at the number like it's a passive-aggressive roommate, knowing it's upset but refusing to tell you why. The frustrating part is that the score isn't simply a judgment. It's a quiet financial penalty that follows you around like a subscription you forgot to cancel. When your score is lower, everything costs more, even though nothing about your life is actually different except the number. The interest rate on a mortgage shifts a little, and suddenly you've committed to giving the bank the equivalent of a small vacation home in interest. It's the kind of long-term cost you don't notice until you're older and wondering how your neighbor somehow paid off their house early while you're still arguing with your loan servicer about autopay. And what makes it worse is that this gap doesn't feel like an emergency. It just feels like slow financial erosion that you hope will fix itself, the same way you hope your laundry will fold itself if you ignore it long enough. Which sounds manageable until you notice what happens next. Chapter 2. How credit scores inflate the cost of borrowing. You know something's off when a 1% difference in interest behaves like a quiet financial mugging you don't notice until decades later. Most people look at interest rates the way they look at calories on a menu, briefly, confidently, and with absolutely no understanding of the consequences. A slightly worse score means the bank gently nudges your rate upward, as if they're doing you a favor by still approving you, and you accept it because the paperwork already took an hour. That tiny bump adds up across 30 years until you've basically bought the bank a luxury car, a vacation, and probably a set of monogrammed towels. And the worst part is, you tell yourself it's normal because everyone else is doing it too, which is also what people say right before getting scammed by timeshares. Each extra dollar spent on interest is a dollar you're not investing, which feels abstract until you try to retire and realize your 401k looks like it spent most of its life napping. The problem is, this isn't happening in isolation. Chapter 3. Expansion of credit scores beyond lending. It's one thing for your credit score to judge your financial behavior, but why does it also behave like it's critiquing your driving skills, rental choices, and general existence? You buy groceries responsibly, yet somehow your car insurance thinks you drive like a Fast and Furious background character simply because your score dipped after holiday shopping. Landlords, utilities, and even certain employers look at this number as if it reveals your soul, or at least whether you're the type of person who microwaves fish in the office kitchen. The irony is that none of these things involve borrowing money, yet the score shows up everywhere like an over-involved parent at a high school dance. You can have a spotless driving record and still pay more than someone who treats red lights as suggestions, because the algorithm has decided vibes matter more than evidence. And then there's the job screening part, where your entire career trajectory hinges on whether you missed a payment once during an emergency 3 years ago. That would be fine, if it stopped there. Chapter 4. The paradox of how credit scores evaluate people. Your credit score has absolutely nothing to do with how much money you actually have, which feels like an important detail someone should have mentioned sooner. You can have a bank account healthier than a fitness influencer's meal prep, but if you've never borrowed money, the system politely labels you a financial non-entity. Meanwhile, someone else can be one unexpected bill away from emotional collapse, yet their score beams with pride because they're really good at juggling several forms of debt like it's a circus talent. The algorithm rewards constant borrowing and repaying, which makes sense only if you assume the ideal adult is basically a well-trained hamster running on a wheel of minimum payments. Paying off loans early, something you'd think would earn you a congratulatory email at least, can actually make your score sulk like you ended the relationship too soon. And when you finally understand this logic, you realize you're not being judged on responsibility, but on how entertaining you are to lenders. The problem is, this logic comes from somewhere very specific. Chapter 5. The credit score's origins and purpose. The uncomfortable truth is that the credit score is younger than a surprising number of pop stars, which already tells you it's not the ancient financial wisdom it pretends to be. Before 1989, actual humans made lending decisions, which sounds charming until you remember humans are famously inconsistent and occasionally racist, biased, or just in a bad mood. So the industry replaced messy human judgment with an algorithm that could standardize everything, meaning it could be wrong in the same way every single time. The real purpose wasn't to help consumers make smarter choices. It was to package your debt into neat little bundles that could be sold off faster than concert tickets. And once risk became something you could turn into a spreadsheet and monetize, lower score borrowers naturally became the premium subscription tier, the one that costs more but offers no actual benefits. High scores got to borrow cheaply, and everyone else was quietly assigned to the "please pay extra for existing" category. The problem is, understanding the purpose doesn't make the system any less confusing. Chapter 6. Key components of the credit score algorithm. Imagine opening your credit report, expecting clarity, and instead discovering it reads like the rule book for a board game no one has actually finished. Payment history makes up the biggest chunk, which sounds straightforward until you realize that the system treats a single late payment like a lifelong personality flaw. Credit utilization is next, and that's basically the algorithm checking whether you look like someone who panic buys snacks at 2 a.m. It doesn't care about the dollar amount you spend. It cares how dramatic it looks compared to your limit, like financial theater judged by a very bored critic. Then there's the trick where simply raising your credit limit makes you look more responsible, even though nothing about your spending habits has changed except the math. And, of course, the authorized user loophole exists, where someone else's pristine financial behavior gets copy-pasted onto your life, which is basically academic nepotism but for credit cards. The strange part is how all these pieces interact in ways that reward optics far more than actual stability. And this is where it quietly gets worse. Chapter 7. Credit repair and legal disputes. Picture discovering that the fastest way to clean up your credit report isn't financial discipline, but catching a typo. Credit repair companies love to present themselves as financial surgeons, when in reality, they're more like people shaking a vending machine until something falls out. The Fair Credit Reporting Act says every detail in your report has to be 100% accurate and provable, which sounds reasonable until you realize how often humans forget to do paperwork correctly. That means a wrong date, a missing document, or a misspelled name can erase an entire negative item. Not because you paid it, but because the system can't find its own receipts. And the wild part is that disputing errors works so well that an entire industry built itself around exploiting this bureaucratic brittleness, even though most of what they're selling is just sending letters politely but repeatedly. When it works, your score jumps as if you suddenly became financially enlightened, even though all you really did was point out someone else's sloppy filing. Which sounds clever, until you realize this still doesn't solve the deeper contradiction underneath everything. Chapter 8. Practical versus philosophical approaches to credit. There's something oddly comforting about the idea of avoiding debt entirely, until you try doing it and realize society treats you like you just chose hard mode for no reason. You think paying for everything with cash will make you look responsible, but to the credit system, it makes you look like a mysterious drifter who might disappear at any moment. Meanwhile, the rest of us participate in the debt ecosystem not because we love it, but because trying to rent an apartment with no credit history is like trying to adopt a dog while holding a "trust me" sign. The philosophical argument says debt is bad. The practical argument says so is being denied a phone plan because you once tried to live like a financial monk. Most people need credit for the basics, housing, insurance, utilities, so avoiding it is less empowering and more enjoy your security deposits the size of car payments. And unfortunately, the system expects you to play along, even if you're doing it reluctantly and with the emotional enthusiasm of someone accepting software terms and conditions. The tension is that the game exists whether you approve of it or not. Chapter 9. Strategies for optimizing a credit score. I'm going to tell you something unsettling. Most of the easiest ways to improve your credit score have nothing to do with being good at money. Improving your score is less about financial discipline and more about performing responsibility in a way the algorithm finds aesthetically pleasing. Automating payments makes the system think you're a stable adult, when really you're just preventing future you from forgetting things the way you forget leftovers in the fridge. Asking for credit limit increases feels counterintuitive, like volunteering for more rope in a system that has already tied a neat little knot around your finances. But it lowers your utilization, which the score interprets as, this person is calm. Keeping old accounts open is another trick. It's basically sentimental hoarding, but for credit history, and the algorithm loves emotional baggage as long as it comes with a long timeline. Even making one tiny purchase a year on an ancient college card keeps it alive, like feeding a houseplant you forgot you owned. The strange part is how all these hacks work beautifully without requiring you to be any better with money. And this would almost feel clever, if not for the final catch hiding underneath everything. Chapter 10. Using the system without being exploited. The simplest way to think about your credit score is as a number that absolutely does not care about you, which is exactly why you shouldn't take it personally. Treating it like a moral evaluation is how people end up feeling shame over things that were really just minor scheduling errors, or the financial equivalent of forgetting to water a cactus. The score rewards certain behaviors, not because they're noble, but because they make you cheaper to manage, which is probably not the compliment anyone hopes for. Keeping the number high is less about pride and more about avoiding the quiet penalties that appear when the system decides you're risky, a label applied with the same precision as someone guessing astrology signs at a party. Disputing report errors matters because the data is messy, and if the system is going to judge you, the least it can do is use the correct spelling of your name. Understanding how the rules work lets you participate just enough to avoid unnecessary financial friction, without pretending this is a game you ever wanted to play seriously. And the irony is that becoming harder for banks to profit from is the one outcome the system never explicitly prepares you for. When you put everything together, the credit score turns into something oddly simple, a number that reflects behavior the system prefers, not the life you actually live. It's strangely comforting to realize you're not alone in misunderstanding it. Everyone is basically guessing and hoping it doesn't get worse. Knowing how it works doesn't create a grand revelation. It just makes your past decisions look less chaotic. And once that sinks in, you start noticing how many parts of adulthood rely on the same quiet math happening behind the scenes. Most people don't question it until a moment when the monthly costs stop feeling abstract and start feeling strangely personal. It's in that pause where things get a little clearer, even if nothing changes immediately. You start seeing the credit score as just one piece of a much larger puzzle you've been standing inside this whole time. And the next piece people usually notice, sometimes reluctantly, is the one attached to their car keys.